as you announced, this talk is about learning credit networks with some applications in financial, but in particular the banking industry. And this work I have done together with some colleagues from ING and also at the university. So just by a show of hands, how many of you have some background in finance or are related to some financial? Okay, I think it's more than I expected, so that's good. Yeah, so just very briefly about me, I'm a trading quantitative analyst within the financial markets in ING Bank. So I'm not officially a data scientist, but I still do a lot of things with data and modeling in particular. And together with that, I'm also a research scientist. So 1 day per week, I spend at the university in the Informatics Institute at the University of Amsterdam. So together with some PhDs and master students, we do also research which looks into how can we apply, let's say, database techniques or modeling techniques into the banking environment. Yeah, so my supervisor at ING also happens to be a professor at the university, so Drona Kandai, and this really helps me to have a good balance between academia and industry. And so far for me, it's been quite nice, this nice balance with what's going on in the industry and what's happening in the research side of things. And just to briefly mention, we have financial support from these organizations. So the Dutch Organization for Scientific Research, we also have projects with KPMG, and we are supported by the European Union as well. So there's a project called Big Data Finance, which looks into applicability of these techniques into trading and risk management. So we also do some research in conjunction with that. Yeah. And before I start, so although I'm a trading quant analyst, this talk is not about trading strategies or ways to make money. Otherwise, I wouldn't be giving this talk here. So just a small disclaimer. Yeah, so I'll start with something which all of you know. I mean, this is something which happened almost 10 years ago, but people still talk about it. And people have changed quite a lot of things because of this. So what happened was Lehman Brothers collapsed. It filed for bankruptcy, and as a result, there was a widespread panic in the entire financial world. So not just Lehman defaulted, but the entire market kind of stopped working for a while. So lots of trading was not happening after this shock happened. And it really changed the way that we do things within banks in particular. So within financial markets, this is really an event which fundamentally changed things in a lot of ways. So my talk is also a bit about what changed after this crisis and how things are done in a different way than what they used to be in the past. So, but the question is, why did the collapse of one financial entity, like Lehman, for example, why did it have such huge repercussions on the entire economy? So that's one. And why did something which started with something very small, so it was a subprime crisis, people were borrowing money to buy homes, and then at some point they did not have any jobs, so they stopped paying these loans. But then why would it affect something like Lehman, which had nothing to do with mortgages, or something like AIG, which was also not giving any money to homeowners? So that's also a question which people have thought about, and there were quite some things happening, let's say, before the crisis, which led to such huge repercussions. So there's a nice cartoon which says, I thought we were just buying a house, but then it led to this whole catastrophic collapse of the system. And one of the reasons why this happened at such a big scale was because of the inherent complexity in financial markets. So because of deregulations and because of freedom provided to, let's say, banks and financial institutions in general, what people did was they took small residential mortgages. So these small houses that you see at the top are people borrowing money for buying a house. But then what was done was that these mortgages were packed into things like residential mortgage-backed securities. And then again, these residential-backed securities were repackaged into what is called a CDO. So it's a derivative. We'll get into what derivatives are. But again, I mean, what you see happening here is through something which is as simple as a home loan, people constructed instruments which were quite complex in their structure, but also it introduced connections which were not present in the market. So if a bank somewhere in the US is giving money to a homeowner, the risk of that particular homeowner is not just restricted to the bank, but it's widespread in the economy because of such financial instruments. So things really got out of hand as a result. The fact that something as small as mortgages could be transformed into something as complex as a CDO. Yeah? So a CDO is a fairly tricky financial product, and a lot of these CDOs were being bought and sold back in the crisis period. So also, another thing that I want to illustrate with this is that such transactions introduced dependencies between financial institutions. So this will be one feature that I'll be focusing on in the rest of the talk. How can we capture this dependency? And how can we quantify this dependency while we are pricing things and while we are trying to determine the risk that we run? So this is just the background. So this is what I was saying. I mean, what happened as a result was that after the crisis, people suddenly realized that things don't happen in isolation in the financial world. People are really interconnected to each other through either financial contracts or through ownerships. And this was a radical shift after the crisis. So people started to realize the importance of systemic risk. So systemic risk refers to the risk of the collapse of the entire system as opposed to collapse of a single entity. And this was a risk which was really shown to be present in the system as a result of the crisis. So here on the left, you see an example of some investigations that happened after the crisis. And this was generated by looking at the equity data. So who owns which company? If you own shares of a company, you own some part of that company. And this was a network constructed from that ownership data. And you see that at the core of this network, you have these big banks, as you would expect, which own a majority of the entire network. So they also drive the decision-making of the financial institutions in that picture. On the right, you see something which people came up with, again, after the crisis. So this is called debt rank. The idea is similar to page rank in Google. So with debt rank, you can quantify how risky a financial institution is based on its centrality in the network. And this helps you to quantify, let's say, if an institution became more risky as the crisis progressed. So these things became more central in the research part of the financial networks. And there's a very nice quote from Andrew Haldane. So he's the chief economist at Bank of England. And he gave a speech called Rethinking Financial Stability, where he said that financial systems are really like complex networks where things do look fairly stable when times are good. But as soon as there is some shock introduced in the system, there is something called a tipping point. And if the system crosses that tipping point, the whole system kind of collapses as a result of that. So what regulators are now trying to do is to make sure by their policies that financial networks are resilient from a network perspective as well. So if, let's say, one bank collapses, it doesn't have this huge repercussions in the economy, which was not the case before the crisis. Yeah. So I'll very briefly mention something about derivatives, because I assume not all of you are familiar with that, since this is the core part of my talk. And then we will look at data and how can we use data to quantify risk about derivatives. So very simply, derivatives are financial contracts which derive their value from some underlying asset. Yeah? So you can have a derivative on a stock, you can have a derivative on a interest rate, on a FX rate, and so on. And the complexity of the derivative comes from the fact that they derive their value from the value of this underlying asset. So you can have a call option, for example, on a Apple stock, and what the value of this Apple stock, so you can observe the value of the Apple stock in the market. let's say it's trading at 100 euros. How do you price a call option which will allow you to buy a call option in the future for 100 euros, irrespective of the price of the Apple stock at that time? So how do you price something like that? It's very tricky. It's not very straightforward. And then what happened was that people from economic sciences, so these three famous economists, came up with a way to price these options way back in 70s, for which they were awarded the Nobel Prize. And as a result, these options suddenly became quite popular. So everyone could price them through this no arbitrage argument, which basically means that you cannot take a risk less profit. So as a result, what happened was that these derivatives started being traded quite frequently in the market. So this is simply a call option, which means that you have a contract which allows you to buy the contract at the strike price, at the maturity of this contract, no matter the stock value. So let's say in 6 months, if the Apple stock is somewhere here, 150, you can still buy it at 100 and make a profit of 50 euros. Another type of contracts which are very popular are interest rate swaps. So, there what happens is that as a borrower, if you want no risk to the interest rates, if you want to hedge out that part of your risk, you would enter into a swap contract where you would pay a fixed rate and receive a floating rate. So as a borrower, effectively, you are paying a fixed rate for any kind of loan. And these contracts are also hugely popular in the market. So you will be surprised by the total market value of the derivative trades in the world today. So any guesses about how much the value is? Sorry? So, 5. Yeah, so it's actually 12 trillion. And this is after things have declined quite a lot from the crisis, you see. So here you have different kinds of derivatives. You have interest rate, FX, commodity, equity, credit, and so on. And the biggest portion is interest rate derivatives, as I mentioned. And this is 10K, but it's billions of USD. So it's quite a significant amount. And there's a huge market with lots of players in this market who are actively trading these derivatives on a daily basis. So there's a huge risk in the system. And even though, let's say with crisis and regulations, things have slowed down, it's still quite significant, I would say. And it might be with these deregulations which are being proposed that the trend increases again. You know? So just as a comparison, India's GDP is 2 trillion. So this is 6 times India's GDP, by the way. So it's quite a lot. I mean, not many people know about derivatives, but they do have a huge market value, and they are traded quite actively in the markets. Yeah. Any questions so far about derivatives? Or, okay. So the reason I'm talking about derivatives is because after the crisis, as I said, the derivative market changed quite a lot. There were lots of regulations that were introduced in order to deal with the counterparty risk. So the risk that your counterparty might default in a contract. Yeah. So if you have a trade with, let's say, Goldman Sachs, in 5 years from now, Goldman Sachs might not exist. This became a reality. This is something that could happen. So banks were asked by the regulators to keep a reserve in order to protect themselves against the counterparty-related losses. And this is what I've shown. I mean, you can have expected and unexpected losses that the banks calculate on a daily basis. And these losses depend on 2 things. One is how much can you lose? And the other thing is what's the likelihood of that default of your counterparty. So these 2 things go into this calculation. And for the first part, what we do is we simulate the market risk factors, so things like stocks and equities and interest rates, FX, by a Monte Carlo simulation. And then we get a distribution of what the exposure can be in the future. And based on this exposure, we calculate these measures. So from an engineering perspective, this is also a very interesting problem. Just to price the CVA portfolio for ING, for example, for a bank like ING, you would need to do approximately 3.75 billion pricing valuations just for one CVA run. And that's why we have to do things on CUDA instead of even C++. So we use parallel programming, and we program things in the efficient way, which can allow us to calculate these measures in an efficient way. Yeah. So again, I mean, for PyData, I think what's relevant more is, let's say, from the data, how can we quantify these codependencies of financial institutions to each other? So that's one of the key questions that I have in my talk. And so for that, the first thing that we need is how do banks calculate the probability of default for the measures that I just mentioned? And what banks use are something called credit default swaps. So these are also a kind of derivative where, let's say, you have a contract between the protection buyer. So this buyer is selling a CDS contract to some, this person is selling a CDS contract to the buyer to insure this reference entity. Yeah, so it's like buying an insurance on your house. And the more costly the insurance is, the more chances are that your house might be robbed, or there might be some accidents with the house, let's say some fire and so on. So the market implied probability of default of a counterparty can be calculated from its CDS spread. And as you can see, when there was a crisis in Greece, the debt crisis, the CDS of Greece jumped quite a lot in the market. So it was trading at a very high price, which means that if you have to protect yourself against the default of Greece, you have to pay a lot of money, yeah, because a lot of people think that Greece might default. So these CDSs are a good way to infer the likelihood of default of a counterparty. But then they're also quite controversial because they were one of the central instruments in the crisis. And unlike insuring your house, what happens is that, so when you insure your house, it's only one house and there's only one insurance on it. But the CDS is a bit different because on one reference entity, you can have thousands of CDS. So it's like 1,000 people buying insurance and selling insurance on your house, which sounds a bit strange, but it does exist, yeah? So even the Pope says that, they are unethical. This was in the news. This was not a joke. So this is from even 10 days ago. I thought it was quite funny because I'm not sure why he cares about CDS contracts in general. But for us, it's good in the sense that it allows us to calculate what the market's perception of a counterparty's likelihood of default is. So as I said, I mean, the questions that we have for our purposes is how can we measure the codependence of default among our counterparties? Because it's a network, right? So if you are trading with, let's say, 100 counterparties, they are all not in isolation. They all have linkages. They all have connections between them. And let's say if one of our counterparty defaults, it's not just that counterparty which is going to be affected. It will also affect lots of other counterparties in that region. So how can we really quantify that? And how can we bring that into our pricing framework? Yeah, so this is the main question that we have as a risk management team. And again, I mean, this is a picture that is from Financial Darkblatt, which shows, so they used a nice network representation to show what would happen if Deutsche Bank, for example, defaulted, its impact on the other banks in the area. So, okay. So given that this is the question, how do we approach it? And in order to do that, what we do is we look at a specific case of the recent Russian financial crisis. So here we have the events in Russia from almost 2 years ago, when there was the Crimean invasion and, well, all these cases with the flight being shot down. And at the same time, what was happening was that the oil prices was significantly falling, which caused the ruble to deteriorate quite significantly. And if you look at this point and this point, the ruble almost fell half in its value. So if you are a bank trading with counterparties in that region, you are exposed to this huge amount of risk because if you're supposed to get payments in rubles, what you're getting is going to be half. So you have to really account for these situations that can happen. And you also have to know that if this happens with a certain institution in that region, how is it going to propagate through the system? So these are the two key questions that we have. And apart from things going in distress, what also usually happens in financial markets is that things, again, don't happen in isolation. So as you see that the ruble is going down in its value, the credit default swap of Gazprom, which is a Russian entity, is going up at the same time. So on one hand, you are likely to lose a lot of money, but then at the same time, the likelihood of you losing that more money is also increasing. Yeah, so this is what we call wrong way risk. And this is, again, something which happens due to interlinkages in the financial market. So in order to quantify the interlinkages between our counterparties, what we did was we tried to use a Bayesian network with some modifications to the methodology. So I'll just briefly go over this Bayesian network because I assume some of you are already familiar with this. So a Bayesian network is a directed acyclic graph. It looks something like this, where each of the nodes represents some random variables with some probability distributions. And the edges represent the direct dependencies that you can have between these random variables. So what you try to do is you try to learn these structure, first of all, and you also try to learn the parameters that you have in this conditional probability distribution. And the good thing about Bayesian network is that if you know these parameters, you can quantify the conditional probability of a node, conditional on its parents. Yeah? So I can say that the probability of the grass being wet if the sprinkler is on and the rain is also happening is quite high. Yeah, and so on. So for all the cases, I would know a way to get the likelihood of a certain node in the system. The other good thing is that the joint probability distribution can be presented in a very compact form. So here I can write the joint probability distribution of all the 4 variables in this very simplistic form. And the reason I can do this is because of the dependencies that I have learned over there. So I know that the node W only depends on S and R and not on C, for example. I know that node S only depends on C, node R only depends on C, and so on. So with this, yeah. So with this, you have a compact way to learn the parameters and then use them to infer your conditional probabilities. So, so you can use something which is called a hill climbing algorithm to do your structure and the parameter learning. And there are packages which allow you to do it in a very nice way. So there's something called PGMPY in Python. And there's also bnlearn, which helps you to do this in a very easy way. But the idea is that you simply start with some graph, and you keep adding edges to it so that your score, and this can be some information theoretic score, increases as you progress. So this is the principle. I'll just show a very quick example. I'm not sure how much time I have, but I have it in this notebook. So let's say you have these structure. There's a node X, which is related to both Y and Z. It points to both Y and Z. And you have these probabilities that you want to learn. And then you have this other example where you have a V structure. So you can simply generate some data, and you can use this data to infer what the structure should be. And this is quite easy. The only thing is that Python does not do a great job. So I don't know if I should say this in a PyData conference, but Python is not the best when it comes to Bayesian networks. So you see that it does a very good job in learning the first network. So it learns the edges quite well. And also the parameters are quite well learned. But then in this case, it learns the opposite of what is actually the case, yeah? So, but with bnlearn, you can do a pretty good job. So again, I mean, this is an academic repository which is maintained by somebody who is at Oxford. And he does a very good job at updating this library with the most recent developments in, let's say, Bayesian statistics. So I would highly recommend bnlearn if you're trying to do something with Bayesian networks. Okay, so coming back to our presentation. So again, I mean, the data that we go use in order to detect dependencies is the series spreads. And this is where we have to do something special, because we can't just feed all this data into the learning network, because it's not Gaussian. The distribution is not Gaussian. So what we did is we introduced a notion of epsilon drops, which simply measures the points from which there are jumps in the time series. Yeah? So if this is a local minima of your time series, and if the time series jumps from this local minima to this point, and if the jump is bigger than a threshold that you can decide to be the standard deviation in the last 15 days, for example, it can detect those drops, and it can tell you which are the points of distress in the time series. Yeah? So I know that these are the points where the time series really showed a distress. And for us, this is good to know, because once we know the distress for one entity, we can do the same for two of them. And we can really see, let's say, if this entity is showing a distress on day t, whether the other entity is also showing a distress on day t or not, yeah, or with a delay. So the blue dots here are the distress in this orange time series caused by the blue time series. So these overlap. And then this is what we can feed into our Bayesian network in order to make it learn the parameters of the network. So it's a way to modify the existing Bayesian learning technology and make it suitable for our purposes. So once we feed in this epsilon drops for two parts of the time series, so we do a calibration for a calm period, which is here, and one for this distressed period, we get very interesting results. So the picture on the left shows you a network in a very calm state, and there you don't see very many dark red nodes. But on the right, which is the distressed period, you see that the top part of the network, which consists mainly of the oil companies, suddenly becomes concentrated in terms of the stress that it has on the rest of the network. So these cells represent conditional probabilities of each of these nodes, conditional on the default of this node. Yeah? So this will tell you, for example, what's the conditional probability of default of this, conditional on this. So from to relationship. So you really see that there is a cluster which emerges in the network. And these are indeed the companies which are systemic for that region. So if Gazprom, for example, defaults in Russia, it will have huge repercussions on other counterparties in that region as well. But something which is, so let's say this VIP, which is one of the banks there, smaller banks there, it will not have such huge repercussions. So as a bank, when we are trading with these counterparties, we would like to adapt our charges depending on how risky a counterparty is within that region. So this is how we use this conditional probabilities. And since these are conditional probabilities, we can directly use them in our pricing and risk management framework. And that's why we cannot use something like correlations, for example. So we really need probabilities which are conditional on the default of a counterparty. And with this, we can also construct nice networks. So here you see that if Gazprom is in stress, it doesn't affect the network so much. This is in a calm period. But in a crisis period, you see that suddenly all these nodes that I showed to you in the top part of the heat map, they become quite risky in the sense of propagating stress. And the stress also propagates further in the network than it did in the calm period. So it really shows you with networks, how can you capture stress propagation? Yeah? So how can you measure dependence of default of financial institutions? And then how can you adapt your risk measures as a result of this? And data is really key here, because we cannot know, let's say these two companies will not tell us if they are trading with each other or not. So the only way that we can infer this is by looking at some data related to these companies in the market, and then make all these inferences based on that data. So just to conclude, I mean, this is, again, something that I have said before, but for the two broad things that we calculate within FM, one is related to expected and the other is related to the unexpected losses. If you take this systemic risk into account, the reserves are much higher than what they should be, which tells you that banks, when they're calculating these measures, they are not including the systemic risk in their calculations, which is bad, because if something goes wrong, you will not have enough reserves to deal with such a situation. Yeah, so you should really try to integrate the systemic risk, which is present in the system, through some data-driven techniques into your pricing and risk management. So this is where I'll stop. So this is an ongoing work which I do together with some colleagues, and we also publish it in some academic journals. So this is the article where some of these results are based on. And if you're interested, I can share this with you. Yeah, thanks.
So any questions? I'll hand over microphone to a group here. You first. So.
I was wondering, because I think with the Bayesian networks, you make the assumption that they're acyclical.
Yes.
Is that a realistic assumption?
Well, if you don't assume that they are cyclical, what can happen is that, let's say if there is a cycle, this cycle will cause you not to measure things accurately. So this is a way to make sure that you are quantifying stresses only in one direction. And anyway, we are stressing one node and trying to see its effect. So we don't care if the stress hits this node back to that same node. So that's one of the reasons why we picked Bayesian network. The Bayesian way of modeling things. Yeah.
Yeah. So I'm wondering how many steps you need to consider to assess all the risk. Like you're defaulting and you're trading with me, but I'm trading with him and he's trading with the next and so on, right? So
Yeah.
how does it actually propagate till the end, or at some point it drops down, or do you have any
if you
best
look at
way
this,
of dealing with this?
Yeah, so if you look at this picture, there's something called shortest distance from a node that you can compute in a network. And I would say that in this case, it's something between 3 to 4. So within 3 to 4 steps, you can reach the entire network if it's a small region. So things are pretty connected. And one of the key concepts in network theory is that you have these hubs. So for example, if you look at the social network, there are celebrities, and you can connect to any other person in the world with 6 links or less. And the reason you can do this is because you would know somebody who is a friend of somebody who is famous, and then through that you can reach a lot of other people. So the same thing applies to financial networks as well. If you have 1,000 banks, not all of them are equally risky. Some are much more risky than the others, and some are also trading a lot with other banks. So the stress can propagate very quickly. That's one of the reasons why things got so worse in 2008.
Is there, to your knowledge, or just a simple explanation, a way to incorporate, for example, the intuition of time series analysis, though? Yeah. So when you run this analysis and you get the network, but let's say one bank sells its asset from another institution, can you tell the system this happened? This, when you know that there's a dependency that was lost, or?
Yeah, that's a bit tricky. You can, of course. So that's indeed a difficult problem, because banks don't reveal to each other, or in general, financial institutions don't have the obligation to tell who they are trading with. So it's, again, we are making a big assumption by looking at this CDS in assuming that when these two institutions move together, it's likely that they are connected. Otherwise, they would not have a co-movement. So, but again, this is something that you can try to, it's a difficult problem to infer really if this is happening or not. Yeah.
Okay, maybe time for one final question. Yeah. Can you pass it over? Two final questions then.
They look like two completely different networks. The network in rest and the network in distress.
Yeah.
What is the transformation between the two? Can you derive in some way the transformation from one network to the other?
So with networks, what you can do is you can measure things like degree distribution. So one of the things that has changed in that picture is that some of the nodes have become bigger, and the size of the node represents how connected this is to the other nodes. So things in distress become more connected. That's a feature that has been also observed by some other researchers. That's one. And also, the stress propagates to much larger distances than it would in a less connected network. So you can statistically make a distinction using some network statistics between these two structures. You can do this. And usually what happens is that things become more connected as crisis is about to approach. Is that, or?
Yes and no, because the right picture is much more interesting. That's when defaults start to happen. Left picture is not.
But here also what we did is we stressed this node completely. So we calculate so the color of the node denotes conditional on the default of this, what's the likelihood of default of this. And the reason why you have less red in this picture compared to that one is because things were not so connected here. So the fact that here you have more stress propagation to other nodes, it's an artifact of the reason that networks did become more connected as the crisis came in. Yeah.
Okay, thank you.
Yeah.
A question of kind of a different nature. Could you comment on the choice of CDSs instead of equity prices or bond prices?
Yeah, so CDSs because, as I said, most of these measures that we calculate use CDS as an input for calculation of probability of default. And therefore, so that's why they're called credit networks. I mean, CDSs really represent the credit quality of an institution. So if you would like to measure the credit quality of one institution compared to the other, you would like to see how their CDSs are co-moving, let's say. That's why. You could use equity data as well, but it's not directly linked to the credit quality. That's why we use CDS. And it's a fairly liquid market, so the volume is also quite big, and these are traded daily with quite some volume. So it reflects what's going on in the market about these companies.
For any more questions, I would say let's find Sumit in the break.
Yeah. Yes.
We will have the next talk here at 2:45. So let's give a final round of applause.
Thanks. Thank you.